the first trading day of March 2019. But before we do that, take a quick look at this disclosure, and then we will go right to the S&P. So today is the first day of March, which is the month of the Gann natural beginning of the year, March 21st. The March quadruple options expiration is often one of the biggest of the year. In March 2000, it tied to the bull market bubble top. In 2003, it tied to the start of a new bull market. And of course, in March 2009, the March quadruple option expiration tied to the end of the bear market. Remember that the all-time S&P high, let's pull back the chart here a little bit, the all-time S&P high occurred on September 21st, right here last year, on the autumnal equinox, and roughly 90 days or degrees later was the big Christmas low near the winter solstice, December 21st. The low was actually December 24th, Christmas Eve low. This March 21st, the spring equinox, will be 180 degrees from the all-time high and 90 degrees from the December low. The natural tendency for a quarter-end markup. The natural tendency is for a quarter-end markup or a sell-off from whatever the prior direction of the trend has been for that quarter. However, often the seasonal factors of solstices and equinoxes exert their natural pressure one way or the other. This year, the big quadruple option expiration is early, coming mid-month, with the first Friday of March landing today. So we've got an option expiration, a quadruple option expiration, mid-month. The usual pattern is for an early March spike, up spike, that the ARBs sell into, with a subsequent walk down into the quadruple options expiration, and then after that a possible quarter-end markup. So you can see that beginning from the top on September 21st, the end of that quarter, you had a whole quarter basically down, and so we may get a whole quarter up, but I don't think it'll be in a straight line necessarily. As I said before, the natural tendency is for the option expiration ARBs for a misdirection up spike to start the month and then walk it down into the quadruple option witching, which is mid-month this year, and then a possible, if there's going to be, and then a possible move up into or markup window dressing into quarter end. So the ARBs may short into a spike early this month, even as early as today, for a misdirection move and down into option expiration. So today promises to be interesting as we approach the key 2800 level again. You can see that back here in early October, the market pushed over, the S&P pushed over its 200-day, this magenta line, to 2813 before a plunge. Then again in November, it pushed above its 200-day, the magenta line here, to 2815 before another plunge. And then in early December, again another push above the 200-day, right to 2800 before a December massacre. We may have a little difference in complexion this go round, because we have been above the 200-day for more than these 1 to 2 day affairs back here last fall. We've held above it now basically 2 weeks, but we still haven't cleared this 2815, 2813, 2815 level. In fact, Monday's signal reversal bar high was 2813. Let's pull back the lens a little so see if you can or drill down to see if you can see it. Here's 28.13, and you see we had a gap up on Monday with a close at near session lows for what I call a Gilligan reversal, a Gilligan sell signal. A Gilligan is simply a gap up to a new 60-day high with a close at near session lows, which is what we got on Monday, and the market did follow through to the downside. What's interesting is that this morning's upthrust is coming off another +1, -2 buy setup. This is a pattern or strategy that I created to define continuation moves, either up or down in up in bull markets and down in bear markets, and I'm going to show you what that is. The +1, -2 buy signal occurs when the 3-day chart is pointing up, and then you get two consecutive lower daily lows, not closes, but lower daily intraday lows are struck. And that doesn't have to be right after the 3-day chart. Right after the 3-day chart is pointing up, you don't need to get the two consecutive lower daily lows immediately. It is the first two consecutive lower daily lows, but it's remarkable how often, I'm going to show you here, how often that setup occurs immediately after the 3-day chart is up on the first two consecutive lower daily lows. So the 3-day chart turns up and remains pointing up when you get three consecutive higher daily highs. Right off the December lows, the 3-day chart turned up. You had three consecutive higher daily highs, 1, 2, 3, authoritatively, unequivocally, right off the lows. And almost right on the heels of that, you got two consecutive lower daily lows. All these points A, labeled A, are when the +1, -2 pattern, when the S&P was in that position, the +1, -2 buy setup. Each of these times, the 3-day chart was pointing up, and you had two consecutive lower daily lows. Here, 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 and again here yesterday. So these points marked A on the chart show the prior instances this year where this +1, -2 daily buy setup took place. Now the market doesn't always blast off right from these setups, but in strong uptrends they do define lows. So you can see here the market didn't blast off here. It stutter stepped around before continuing higher. Here too, it didn't blast off. You had a 1-day pause, stutter step, and here again you had the +1, -2, and yesterday was a very narrow range inside day. What is surprising about this morning's liftoff, the futures are up 15 before the open here. What is surprising about this morning's liftoff from yet another +1, -2 buy setup is that there were several reasons to expect that the S&P would continue to pull back into today's weekly option expiration. Why do I say that? Well, first and foremost, the important 3-day chart has not turned down since the rally started in December. In other words, all throughout this rally, there are no instances where you have had three consecutive lower daily lows. Again, intraday, there are no instances where you have had three consecutive lower intraday lows throughout this whole rally. And after Monday's signal reversal bar, you had a lower daily low, another lower daily low here, and it would have been easy for the S&P to satisfy that with a lower daily low on Thursday, but it was not to be. Now the whole pattern has to be rejiggered in order. The 3-day chart is due to turn down. It's stretched. It's been up for over 2 months, for 9 weeks now, going into the 10th week actually, and it is due to turn down, but now you have to reset again. You have to get three consecutive lower daily lows. So that is a potentially bearish thing on the one hand, that suggests that this gap up this morning is suspect. Even if it holds today, it may be suspect going the next week. Or you could construe it as very bullish that yet another two consecutive lower lows is perpetuating a strong impulse up. So the three consecutive lower lows have not played out yet and has to be rejiggered because we're not getting three consecutive lower daily lows. As I said, given the downside follow through from Monday's signal reversal bar and with the 3-day chart stretch, the expectation was that a third consecutive lower daily low would play out on Thursday with trade below Wednesday's low. It didn't happen. Instead, the market is responding to yet another +1, -2 buy setup as it did at all these points A throughout the entire rally. Additionally, another reason why there was a presumption that the S&P would continue to pull back from this 2813 level from Monday was that it looked like it was on a trajectory to tag this line of least resistance right here. This ties to a 6-week trend channel. So what I've done is connected all these lows and then paralleled another trend line that connects these tops. So the presumption was that the S&P would pull back, would be magnetized lower to the from this little sell signal up here to test the bottom of the trend channel in conjunction with, in tandem with, a 220 bow tie. That is simply this intersection here of the red line, the 20-day moving average, and the magenta line, the 200-day moving average, which come in right at this 2750-ish level. At the same time, there is a gap at 2745 to 2760 right here that is congruent with this same level of this trend line and the 220-day moving averages, that bow tie right here. So the expectation was that the market would pull back to test this and pull back the rubber band to gather strength for a possible move into the to the top rail of this trend channel. So you have the gap, you have the 2200 bow tie, and you have the lower rail of this trend channel, all beckoning, yet the market is gapping up. It's got an idea of its own. So today promises to be interesting as the S&P approaches this 2696 level. Why is that interesting? Because 2696 is the high close for the whole move off the December low. It's Monday's close. Now, the old maxim is that markets like to close on their highs on Fridays in a bull run, and accordingly, believe it or not, there hasn't been a red Friday in all of 2019, and the bullish pajama traders are doing their best to circle the wagons and make sure we didn't get a poor close today. At least that's the way it's starting out. As a close at the lows of the week today, let's take a look at the weeklies and you'll see what I mean. A close at the lows of the week today would have left a signal reversal bar on the weeklies. In other words, you would have had your first weekly topping tail if this week had closed near the lows, and that would have set up a bearish technical psychology to start out the month of March. Indeed, the weekly swing chart has not turned down since the Christmas low, and it too is stretched. You can see that throughout this whole rally, you've never had a weekly decline below a prior week's low. if the market had continued down today below last week's low, it would have turned the weekly swing chart down today. In doing so, you could have had an outside down week, which would have indicated correction mode. At the same time, if the S&P had closed below last week's low, you would have had a key reversal week. The reason to mention this is that it looks like the bulls have circled the wagons overnight when no one's around, and the market is jackknifing higher on the open to give it a cushion after some bending in the trend throughout this week. As they say, the trend is your friend until it bends, and it looks like the bulls don't want anything to bend, at least into, they're trying to keep it up, it looks like, at least into the quarterly option expiration. The option expiration arbs are trying to keep it up until then, and the money managers look like they want to keep it up into the end of the quarter. Remember, these money managers aren't market timers, and they're almost legally required. They can't time the market. They're almost legally required to be in until the end of the quarter. That's why you get so many important turns, either up or down, at the beginning end of quarters. So I don't think these considerations of where the weekly chart was going into this morning were lost in the bulls, and they're putting as much distance as they can this morning between this week's lows on overnight trade here. So it's going to be interesting to see if the option expiration arbs take advantage of this morning's spike and sell into it for a walk down into mid-March quadruple OPEX, or whether the S&P successfully attacks and clears Monday's highs. Let's go back to the dailies. Clearing Monday's close at 27.96, and then clearing Monday's highs, the weekly high, this topping tail high at 28.13, is the gateway for a push to 28.40ish and the top of this trend channel. Remember now that Monday's reversal is from the same region as the October, November, and December reversals. So the action here to kick off March and the move into the Ides of March and the anniversaries of the three biggest turns of this century, the March 2000 top, the March 2003 beginning of the bull market then into 2007, and the March 2009 bear market low will be critical. So that's it for now. Let's see what they do after the first hour today. Appreciate your time. Thanks for listening. See you next time.